Hello, welcome to Lecture 5 of Financial Statement Analysis. Today's topic is on ratio analysis, and ratio analysis is a very important part on our business analysis framework. We're down into step 2 on analyzing information, and we're finishing it off with ratio and cash flow analysis. In today's lecture, I've broken it up into multiple parts. First, I'm going to give you a brief introduction to ratio analysis. Then, because what we're going to learn today is heavily reliant on reformatting, the topic we learned last week, I'm going to do a brief amount of revision on reformatting the financial statements to cover the key terms that we've introduced into the topic. We're then going to do a little bit more revision on the problems with traditional DuPont analysis before going into the solution, that is advanced DuPont analysis, finishing off with some other ratio analysis that's important in understanding a business's performance, and then I'm going to finish off with a demonstration of ratio analysis in Excel. So the broad aim of today's lecture is to learn how to calculate financial ratios from our reformatted financial statements. The benefits of calculating ratios is that it allows us to understand the operating and financial drivers of a firm's performance over time. This is really important in valuation because when we make forecasts of the future, we want to make sure that these forecasts are actually plausible. So if we have a strong understanding of the operating and financial aspects of the business historically, then when we make our forecasts into the future, we'll have a much better idea of if our forecasts are plausible and realistic based on historical trends. Whenever you do ratio analysis, one of the key important takeaways is that a ratio on itself is pretty much meaningless. To give meaning to the ratios that we calculate, we need to evaluate the ratios against some sort of benchmark. So some common comparisons that we're going to use are calculating ratios over a period of time. This is called time series analysis. So for a company, you might go back and calculate their key financial ratios over the last 5 or 6 years. Then you'll get an understanding of how the ratio has changed through time. Is this year better or worse than last year? That's a very simple level of analysis using time series data. Another way of analyzing ratios is by looking at the ratio compared to industry competitors. So this is called a cross-sectional ratio analysis, in which we compare our firm to other firms in the same year in the same industry. This is really powerful because it allows us to see if our firm's an outlier, if they're behaving differently to other firms, if they're doing better or worse than other firms that may have similar strategies selling similar products. Very rarely we may use absolute benchmarks. For example, when we analyze a company's return on equity, we're often going to compare that to their cost of capital. So we need to make sure that they're earning a return higher than their cost of capital to actually create value. So that would be an example of a somewhat absolute benchmark. And then sometimes we have rules of thumb for other ratios where we say higher than this level is good, below this one might be bad. But we always have to have a nuanced opinion of these and do a little bit more research before those benchmarks are usually. Some benchmarks apply when we have regulation involved, such as banks. They're required to have certain levels of capital. That means, in a very simplified way, the debt to equity ratio they have, or the amount of equity they actually have to hold, is regulated by, in Australia, APRA, the banking regulator. So sometimes there are absolute benchmarks as well imposed by external bodies like regulators, or if we know a company's got debt covenants, they've gone to the bank and borrowed some money, and sometimes those debt covenants are public, we can see what sort of ratios they must maintain to keep that bank loan of theirs. A final thing we look at is often common size analysis to compare different firms. We've also talked about this as being called vertical analysis previously, where we'll compare certain line items on the balance sheet, income statement, or cash flow statement as a percentage of, for example, balance sheet, all our assets as a percentage of total assets, income statement, all our accounts as a percentage of total sales. Then we can compare different firms based on their common size analysis of the financial statements. And that's another useful and relatively simple way of comparing business performance with each other. As you do your ratio analysis, you'll see the formulas are usually reasonably simple. The mathematics behind the ratios is not very difficult. Usually multiplication and division is about as difficult as the maths get. Because the maths isn't very hard, we have computers that can calculate these ratios for us across multiple different firms very quickly. So the ability to be able to calculate these financial ratios is not a very unique or special skill. We need to be able to do it, but what's more important is the fact that you can understand and evaluate the ratios that you calculate. Essentially, after you have calculated the ratios for your firm, You want to be able to tell a story about your firm's performance, and the ratios need to provide evidence or proof to that story that you're telling. So effective ratio analysis must relate to the underlying business factors. I've underlined that here because it's really important. When students do their assignments and they calculate ratios, one of the most common mistakes they make is they just tell me the profit margin this year went up from 3% to 4%, and they leave it at that. They don't tell me why the profit margin went up. So, ratio analysis should aid your understanding of the business model, the returns that the firm generates, and the firm risk. But you also have to have an understanding of what's happening in the business to aid your understanding of the ratios. Telling me the profit margin went from 3% to 4% isn't very interesting unless you can relate it to what the managers and the business are actually doing. Did the profit margin go up because we went on a cost-cutting campaign? Did we change the prices that we're selling our products for? Did we cut some of our unsuccessful products? We need to be able to think about what caused this ratio to change. Does the actual underlying business, the operations of that business, make sense with the ratio? So we need to be able to compare what's happening in the business, what do we see in the financial ratios, and then you can tell a story about how the business is performing. When we conduct ratio analysis, we often start with the profitability and the growth of a firm. Profitability and growth are really the key drivers of firm value. So when we do ratios, we often start with looking at the growth of the firm, which is usually a relatively simple thing to calculate, and then we're going to go into a lot more depth on the profitability ratios. Broadly speaking, managers can employ 4 different ways of managing their growth and profit targets. They can change the operations of the business. They can change their investing strategy. They can change their financing strategy and their dividend policy. All these 4 factors will influence a business's profitability and growth. So there are 4 very large areas of management, and all these areas are going to influence our profitability and growth, and that will show up in the ratios that we calculate. We want to be able to understand if a business is effective, their operations, investments, financing, and dividend policy. And alongside the profitability and growth of the firm, we also want to get an understanding of the risk that the firm has. We want to be able to understand if the business is going to be resilient to changes in the economy, if it's likely to continue succeeding in the future, or if it runs the risk of going into administration or bankruptcy. First look at the firm's performance, we normally look at growth. And when we talk about a business's growth, we generally look at their sales revenue growth as a first thing to look at. So sales revenue growth is actually really easy to calculate. You'll all be able to do that very quickly. You take the sales revenue from the current year. So the little T subscript here means the current year. And we minus sales revenue from the previous year, T minus 1 last year. And we divide through by last year's sales revenue in T minus 1. And all that does is it gives us a percentage change. Did our sales go up or down, and what percentage did they go up or down? And we do that for the last couple of years, and we understand if the sales growth is showing a positive or negative trend and how much sales may be growing over time. Now, we're going to talk about sales growth a lot more in next week's class when we look at forecasting. So I'm going to not touch on growth as much this week. We're going to focus more on the profitability ratios. The other growth ratio that's worth looking at is the sustainable growth ratio, which is your firm's return on equity times 1 minus the dividend payout ratio. This gives you an idea of how much a firm will be able to grow in the future without having to raise external capital. If I've got a return on equity of 10% and I'm paying 30% of my profits as dividends, I would be able to then reinvest 7% into my business, so I'd be able to have a sustainable growth rate of 7%. If I want to grow by a faster rate, I would need to go to external capital providers, raise some debt or equity. So the sustainable growth rate gives us an idea of how fast the business can actually grow given their current dividend policy. So overall, growth is a pretty easy one to get a vague idea of historical performance. We can calculate some percentages, we can calculate a sustainable growth rate, but next week when we talk about forecasting, we'll learn a few of the tips and tricks to make sure that we understand how past performance doesn't always lead to future performance in sales growth.